So in this video, we're going to discuss about the four types of investor. In fact, there are other types of investor, but I want to talk about the four main ones. So first of all, we have what is called the value investor. So this kind of investor is just like Warren Buffett, or the one that created this strategy, who is called Benjamin Graham. It's really a style of investing that mainly focuses on the price of the valuation of the stock of the company. It believes that the most important part about investing is really about buying the right price a company. To do so, they have one wonderful indicator that is called the PE ratio. So this is simply the price of the company divided by the earnings, so the real actual earnings, okay, those that were just published in the last 12 months, because they don't like to rely on future expectations, because those expectations are made by analysts who are sometimes really wrong. Now you have to understand that having a good price doesn't mean you have a good company. Okay, for example, Benjamin Graham really was the creator of that strategy, and Warren Buffett started his career by doing it. He was really a believer of buying good companies at a great price. Then he met Charlie Munger, who teach him about another way to see value investing, which was buying great companies at a good price. Okay, so great companies, good price right now, and before it was good companies, great price. So typically, Benjamin Graham was seeing the PE ratio as an indicator that was really giving the value of a stock, and would usually look for opportunities of PE ratio below 15. Right now, Warren Buffett is more inclined to go and look for PE ratio that are under 20, because he's looking at great companies with good price, not great prices. Then we have growth investor. So typically growth investor are really looking at earnings, at which speed the revenue are growing, and typically they aim for at least 20%. They really try to look for companies that are going to make some massive amount of profits in the future, with really growing revenue. Father of this strategy was called Philip Fisher, and Warren by himself said that his strategy was really relying on 85% Benjamin Graham and 15% Fisher. This is not a bad way of investing. I'm saying there are different type of profiles, but you have to be aware that that kind of strategy really relies on analysts' opinions. And as maybe you know it, but some of you might not know it, analysts were so wrong during the beginning of the dot-com bubble. Everybody was really seeing the market going on with the future more gains in the next years, while we were really at the top in 2000. So the methodology is really that you are not looking for an undervalued stocks, because if you buy it now and it has a wonderful growth in the future, the price that you will pay today will obviously tomorrow looks cheap. Then we have a more in-between strategy, which is called the GARP. So GARP stands for growth at a reasonable price. It was created by Peter Lynch. So this is a clear in-between between the value investor and growth investor. We generally consider that it's a combination of the best of both worlds. They have also a wonderful indicator. This is the PEG. So this is the price to earning ratio, but instead of using the actual current data we have, okay, the last 12 months earnings, is going to look for the expected earnings. So this rely a little bit on analysts too. So this is also a danger you have to be aware of. And then it divided by growth. So it can actually spot when a company that is growing really fast can actually be undervalued or overvalued depending on its growth. Okay, it consider that if the stock can grow by about 10%, its valuation is not really the same as a stock that is supposed to grow by about 3% per year. Now, to use the PEG ratio, simply one is considered the fair value, below is considered cheap price, and above is considered expensive. Now in practice, usually it's between 0.7 and 1.1 that we consider it a fair to cheap price. So what's really great about this strategy and why it is really preferred by most people is because value investing tends to perform in more sideways markets, while, for example, growth markets, when we have big bullish cycles of about 15 to 20 years, growth investors tend to overperform the market. So the GARP approach really gives a way for investor to have a somewhat steady way to overperform the market, whether we are on a sideways market or on a really hyper growth market. Then we have the fourth investor. This is called the lazy investor. So basically, it's any investor who thinks that beating the S&P 500, outperforming it, is too much of a hustle, okay, too much hard work, or too hard, or just impossible. Now, the third category is obviously completely wrong. It's not impossible, but it is hard and it is a lot of work. That is why usually for most investors, it just makes more sense to be a lazy investor. And in fact, most money that are flowing in stocks are flowing to stocks by indices, okay, so by ETF, especially the biggest ones. Okay, we have the MSCI World ETF, the S&P 500, and the Nasdaq. So by doing that, actually, as an investor, you are somewhat putting your money where the money flows. So if you're not really willing to work hard on learning market, having a very, very deep understanding, this is clearly a good idea, clearly a better alternative than actually trying to have a hedge while you don't even have a quarter of the education needed to actually find yourself an edge on the market. Now, it's also, if we consider time, very, very time efficient, considering the extra potential income you can make. For people that don't really have a very deep understanding of the stock markets, they can outperform the S&P 500, but usually not by a lot. So if you make like 5% more, you spend 5 times more time at investing, at trying to know where should you put your money at. It just looks a little bit less interesting. I hope this video really helped you guys. I'm gonna cover the subject about how to find yourself hedges on the stock market for those who are really interested by stock picking by themselves and by trying to actually beat the stock market.